Hello and welcome to this discussion on current affairs. And I was talking about the economic related topics. This is for 2020, this year's exam, preliminary exam, which is going to be held on 4th of October. And I know all of you are eagerly preparing and very seriously preparing for this exam. Now, the chance of postponement and all are comparatively less. We never know, but you should be preparing thinking that this is going to happen on 4th of October and let us do it with full seriousness. And my aim is also to identify as many topics as possible which are likely to be asked in this exam. And economics play a very crucial role. That is why we are picking up these topics. So, a couple of 12 topics I discussed yesterday in economic related. Manish has already discussed a series of them. So, I am continuing with my discussion on economics. Now, another topic is elephant bonds. Elephant bonds. So, a high level advisory group on trade policy, high level advisory group HLAG on trade policy headed by Surjit S. Bhalla. Headed by Surjit S. Bhalla, has recently suggested the government to issue elephant bonds. This will help India to recover up to $500 billion worth black money. The idea is we may be able to recover up to $500 billion worth black money. So, these elephant bonds are to recover the black money which is stashed abroad, okay, the black money which are stashed abroad. So, in this idea, this elephant bond is going to be 25-year. I mean, it is the proposal only. Nothing has happened. Please don't say that we have already issued and all. Nothing. It is only a proposal. The proposal is to have a 25-year-old sovereign bond. So, the proposal is to have a 25-year-old sovereign bond. Sovereign bond, the government bond, the bond to be issued by the national government. And this bond will be issued to those people who declare their previously undisclosed income and are then, what is there outside India, which has been taken out, the previously undisclosed income, and the suggestion or rather the proposal is 50% of that amount should be the undisclosed amount, 50% of the undisclosed amount will be deposited or invested in the sovereign bonds for 25 years. And these this amount will be used, this bond will be used only for infrastructure projects. This amount will be used only for infrastructure projects. So, that is what this high level committee, this high level committee by Surjit S. Bhalla or high level advisory group, HLAG we can say, advisory group, and they said it should be invested in infrastructure and this will boost India's economic growth, and also it also suggested that one of the key features of the proposed mechanism is that the disclosing whoever is disclosing the black money will receive immunity from all local laws. So, the proposal is whoever is disclosing will get immunity from all local laws, especially the laws under the foreign exchange, black money law, taxation law, from everywhere immunity will be given. So, this will enable people to bring their offshore undisclosed money, undisclosed wealth into India without fear of prosecution. So, the idea is bring that money back to India, and if they bring it back without fear, that is going to be helping our economy by investing in infrastructure projects. Countries like Indonesia, Pakistan, Argentina, Philippines, some of the countries has offered similar amnesty, including Indonesia, even Pakistan, Philippines, and even Argentina has all, they have all launched similar tax amnesty schemes and it can be quite successful also. So, this is a limited time opportunity. The tax amnesty, when we say we are offering tax amnesty, this is a limited time. It is a limited time opportunity for specified groups of taxpayers to pay a defined amount in exchange of forgiveness of tax liability. So, tax amnesty, it means a limited time opportunity for a specified group of taxpayers who did not pay or who violated the tax law to pay a defined amount. You pay a defined amount in exchange of forgiveness of the tax liability and the law, other punishments. So, this can even help in reducing the real interest rate in India. It can strengthen rupee, many things are there. So, the high level committee was appointed under the Ministry of Commerce and Industry in 2018. So, this high level Surjit S. Bhalla committee was appointed under Ministry of Commerce. Ministry of Commerce and Industry. Ministry of Commerce and Industry in year 2018. So, and these bonds will be known as elephant bonds, and this high level advisory group on trade policy, they suggested this, Surjit S. Bhalla and elephant bonds. Okay, that is a proposal, nothing has happened, and the government has, whether it is going to be implemented or not, nothing is said. So, we can take it as a proposal. Okay, it is only a proposal. Then coming to the next topic, the index of industrial production. Index of industrial production. So, what is this index of industrial production? So, the index of industrial production, IIP, okay, index of industrial production is the is the production is the factory output. Okay, so it is the basically the factory output, or in fact we are talking about how much is the industrial production we are talking about, and the quick estimates of index of industrial production are released on every 12th of every month. It is released on 12th of every month. It is released on every 12th, or in fact the second point is the Ministry of Statistics and Program Implementation releases it. Ministry of Statistics and Program Implementation. Ministry of Statistics and Program Implementation releases every month. The base year of the index is 2011-12. Base year is 2011-12. That means base year, that 2011-12 will be taken as 100. And the index shows the changes in the production volume of different industrial commodities. The index, when we talk about the IIP, the index shows the the changes in production volume. It shows the changes in production volume, changes in production volume of different industrial commodities, of different industrial commodities. Then so this there are subcomponents of this IIP like mining, manufacturing and electricity. So, there are three subcomponents, that is mining, manufacturing and electricity. Also, this IIP is also classifying according to the use, namely primary goods, capital goods, intermediary goods, etc. So, various types of classifications are there. So, this index of industrial production, the index value is compared to the value it had in the same month last year. So, in the same month last year also it will compare from the previous month also. That is how the index of industrial production will be calculated, and it will as I said, manufacturing, mining, electricity, etc., the broad sectors, 8 core industries of India. In fact, in this IIP, 8 core industries. 8 core industries represent around 40% of the weight, represent around 40% of weightage. 40% of weightage of items that are included in the IIP. So, 8 core industries account for almost 40% of the weightage. Now, what are those 8 core industries? So, these 8 core industries are electricity. This can be asked in the exam. Steel, refinery products, steel, refinery, so, electricity, steel, refinery products, then crude oil, coal, cement, crude oil, coal, cement, natural gas and fertilizers, natural gas and fertilizers. Okay. So, these are the 8 core industries which account for almost 40% of the total weightage of the IIP, and out of this coal accounts for the maximum. See, in fact, the maximum is refinery products 24%. See, if out of the 8 refinery products 24%, then coal is 10.33, coal 10.33%, electricity 19.5, electricity 19.5, crude oil is 9, crude oil is 9%, then cement is 5%, 5.3%, cement is 5.3%, then natural gas 7%, natural gas 7%, then steel 17.299, almost 18%, steel 18%, refinery I already said 24%, fertilizer 2.6, fertilizer is just 2.6. So, all these put together it will be 100%, and 100% of the weightage among the core sector, which is adding up to 40% of the IIP. So, that is what we are talking about. So, the bottom line. So, what are we discussing? We are talking about the the every month, and it comes the index of industrial production, it comes out, and the industrial production, especially in the COVID times, it is nose diving, it is going down dramatically and rapidly, because there is no industrial production going on because of the complete shutdown which we implemented right from March 25th. So, there are issues. So, what is this index of industrial production? So, index of industrial production is the factory output which is contracting. Naturally, it is reducing. It is an indication of the economic progress and economic development, economic growth. And the quick estimates of IIP are released on every 12th of the month, and it is done by Ministry of Statistics and Program Implementation, and it is a comparison from the previous month also. It can be a comparison from the same month last year also. So, that we get to know, and the base year is 2011-12, and the changes in the production volume of different industrial commodities, we can get it, and that is an indication of the economic performance. So, that is the IIP. So, and the core industries, 8 core industries I have already mentioned, and please see the weightage given, the 8 core industries: electricity, steel, refinery, crude oil, coal, cement, natural gas, fertilizer. These are the 8 core industries. So, please be aware of this. Now, coming to another topic. This is about the currency swap agreement recently. Currency swap agreement. Recently, we have signed a currency swap agreement with Sri Lanka. So, this RBI announced a revised framework on currency swap agreement for SAARC countries. See, RBI announced a revised agreement framework on currency swap with SAARC countries. And RBI, of course, with the concurrence of Government of India, decided to put in place a revised framework on the currency swap, and it will be available between 2019 to 2022. And it has been agreed that India will be providing, RBI will continue to offer $2 billion, a corpus of $2 billion dollars. $2 billion. It will be, India will be providing for our SAARC countries, and originally this currency swap agreement with SAARC was agreed in November 2012. Originally it was agreed in November 2012, and recently we have renewed it, a renewed currency swap agreement, and India already has a 75 billion bilateral currency swap agreement with Japan. India has a $75 billion agreement with Japan. See, what do you mean by then this swap operation? What do you mean by that? And it is a swap operation carry no exchange rate. See, in fact, if India is in need of dollars and if there is a problem in our foreign exchange, and if we are in need of some external currency, Japan will step in and provide that in lieu of, we have to provide them in rupees, and Japan will provide us with either dollar or yen or whatever we want. Japan will help us. Similarly, when we say we have a currency swap agreement with SAARC countries, India is willing to give up to $2 billion for those countries which are in trouble or which are in need of foreign exchange. And according to swap operation, no exchange rate or other market risks are not there. The advantages, what is the advantage of the currency swap? Advantages, number one, no exchange rate risk. No exchange rate risk. And the other market risk, and the transaction terms are already set in advance. Transaction terms are set in advance. Transaction terms are already set in advance, and there is no exchange rate risk. And whatever, see, today if we are providing them with this dollars, and whatever be the exchange rate of today or whatever is already fixed, accordingly we will be providing them with that. And whenever this, and in lieu of that, see, suppose if it is between India and Japan, if India needs say $10 billion, and instead of the $10 billion which Japan is providing, India will be pledging Indian rupee, and whenever India gets that money as per the agreement, it may be for 1 day, it may be for 2 months, whatever be the time, India will provide that, and we get that whatever rupee we have pledged with the Japan. So what the advantage is, we are not worried about, or rather Japan is stepping in on behalf of India when we need foreign exchange. So we will not be failing, or we will not be failing in our commitments. We may not have to go to IMF for a bailout package and all, because Japan is standing in for us. Similarly, India will be standing on behalf of the other SAARC countries, whoever is agreeing. We will be providing up to $2 billion. That is what we are saying. So no risk. So this currency swap agreement between countries is an agreement or contract to exchange currencies with predetermined terms and conditions. We are already determining on what condition we will be providing. So it is an exchange of currencies with predetermined terms and conditions. And currency swap agreement can be bilateral, it can be multilateral. ASEAN has a Chiang Mai initiative. Chiang Mai initiative is in ASEAN countries, ASEAN and ASEAN plus 3, ASEAN, then China, Japan and South Korea. They have an agreement called Chiang Mai initiative, and it is again a predetermined or rather a pre-agreed or predetermined terms and conditions for currency swap in a multilateral form. I mean, it is 10 ASEAN countries and 3 of these Japan, China and South Korea are involved in that. So the main purpose of the currency swap is to avoid turbulence and other risks in foreign exchange. So this is to avoid turbulence and other risks, to avoid turbulence and other risks in the foreign exchange market. In the foreign exchange market. So this is to support, and in the exchange rate and all. Okay. So this will help and it will, it will help, it will improve the relationship between the two countries also, it can promote bilateral trade, many things are there. And recently, after the COVID scenario, RBI signed a 400 million currency swap agreement with Sri Lanka. So, with SAARC, it is a $2 billion, and now with Sri Lanka, within that, I mean, $2 billion, India has signed an agreement with Sri Lanka for a $400 million currency swap agreement with Sri Lanka right now. It was signed in July 2020. It was signed in July 2020. Reserve Bank of India and signed this agreement, and that means for Sri Lanka, whenever they require, we will provide up to $400 million of foreign exchange on behalf of Sri Lanka, so that Sri Lanka can have a security of their forex reserves, and whenever it will bring in financial stability for the country. And definitely Sri Lanka is hit by this COVID, especially Sri Lanka depends on lot on tourism, and naturally Sri Lankan economy could not be in the best of the shape. And in fact, this will be available till November, this $400 million till November 2022. We have offered it till November 2022, and the Sri Lankan, the president, the Gotabaya Rajapaksa, he made an additional request of $1.1 billion. He made a request earlier, a request to India, an additional $1.5 billion currency swap facility in the month of May 2020. He requested India to provide $1.1 billion facility. But of course, we have provided 400 million right now. Earlier, the president of Sri Lanka asked for $1.1 billion facility with India, a currency swap. That means, whenever Sri Lanka is in need of foreign exchange, in dollars and all, or any other currency, and India is saying that we will stand in for you, we will provide you that money on a predetermined condition, so that they are not worried about the fluctuation in the market, they are not worried about the exchange rate at that time. India will stand on a predetermined terms and conditions. India will give that. That is what we have signed with Sri Lanka. We are offering this $2 billion for SAARC countries. We already have an agreement with Japan for $75 billion. Now, recently, with US, a dollar swap line has also been opened. Okay. Now, with USA, another topic, or with USA, a dollar swap line was opened. The same thing. So, India is working with United States, USA, to secure a dollar swap line that would help in providing additional comfort in an event of an abrupt outflow, or if there is an emergency in an event of an abrupt, or in a sudden outflow of, currency, or if there is a sudden demand for a dollar comes to India. What we are saying is that US will stand in for India. So, US federal, the central bank has is in negotiation with RBI to provide that dollar swap line. So, India has already the agreement with Japan and even with UAE, but today, because of the COVID scenario, because of the economic confusion in the world, so India is trying to get an additional support. So, this will help in stabilizing the rupee, and in fact, the rupee value was going down, and it has crossed even 76 rupees per dollar scenario. Then RBI had to step in, and we had even released some forex reserve in the market also. So, this dollar swap agreement with the US Federal Reserve, it will provide dollars to a foreign, to this US Federal Reserve. In this case, the US Federal Reserve will provide dollars to RBI, will provide dollars to RBI. And at the same time, this foreign bank, that means our the Indian RBI, will provide an equivalent amount of funds in its currency, an equivalent amount of funds in its currency to the federal. So, RBI will provide an equivalent amount in rupees to the Federal Reserve, to the US central bank. So, so that based on the market exchange which is fixed, okay, which is or whatever with the transaction amount we fix, accordingly we will be providing, and the parties agree to swap back these quantities of their own currency at the specified time in future. In future, at a designated time we will swap it back. That is the idea behind the swap line. So, as far as it may be when the next day, it may be within the next, normally which is within the next 3 months, okay, within the next 3 months, within the next 3 months, these currencies will be swapped back and the transaction will be over. So, the idea is to support if there is a sudden emergency in foreign exchange reserve, and it will help countries to meet the short term foreign exchange liquidity problems. Short term foreign exchange liquidity problems can be resolved by having such an agreement, and that is how it has been arranged. So, India for the first time we are negotiating with the US Federal Reserve, the central bank of US, for a currency swap agreement for dollars. So, whenever India requires if a sudden requirement of dollar comes, the Federal Reserve will stand on behalf of India and provide that money, and in return India may be pledging our Indian rupees, we will be exchanging to them, and as and when India has enough dollars, we will re-exchange back. The swapping of the currencies will take place subsequently. Normally, this agreement is for 3 months, so that any time a short term liquidity problem when it comes to India, we will be able to do that. So, we are agreeing, we are negotiating with US for such an agreement right now. So, that is the situation as far as the currency swap with USA. So, we have with Japan, we are providing for the SAARC countries. As far as Sri Lanka is concerned, we have agreed to pay up to $400 million. The entire SAARC countries, we talked about around $2 billion. Now, we are negotiating with the US also. So, that is the situation as far as the currency swap agreements. Now, coming to sovereign gold bonds, okay, coming to sovereign means it is issued by a government, a national government. So, the Reserve Bank of India is issuing sovereign gold bonds to the domestic investors on behalf of Government of India, of course, and this latest round has started from 20th April 2020, and it will continue up to September 2020 in various tranches. I think 6 rounds of gold bonds are issued, and the offering is at an annual interest rate of 2.5%. Annual interest rate of 2.5%. 2.5% interest also will be given, and the sovereign gold bond will be, and this round of sovereign gold bonds are issued in 6 tranches. So, it is issued in 6 tranches, and the Reserve Bank, it is the bonds will be restricted. Now, for whom it is restricted to resident individuals, or those who are residents in India, resident individuals. Then to Hindu undivided families trusts, HUF, Hindu undivided families trusts. Then universities, charitable institutions, See, these resident individuals, Hindu undivided families, trusts, universities and charitable institutions can purchase these bonds. Minimum, what is the minimum? Minimum is 1 gram of gold, and per gram it is fixed also 1 gram, and maximum is 4 kilogram for individuals, 4 kilogram of gold for individuals, okay, individuals, and 4 kilogram for Hindu undivided family, 20 kilogram for trusts and similar entities, okay, that is the latest one. and minimum is 1 gram you can buy and 1 gram rate is fixed, and up to 4 kilograms you can purchase, and the tenor of this gold bond will be for 8 years. It is for 8 years, and at the end of 8 year, whatever be the gold price, and suppose, just to have an example, suppose you have purchased 10 grams today, and say today's value for this bond was say 5,200 rupees per gram. So you have spent 52,000, for 10 grams. Now you paid 52,000 rupees, and but this is counted as 10 grams you purchased. Now at the end of 8 years, 52,000 into 2.5% into that 8 years, interest will be given, 2.5% interest will be given to you, and plus whatever be the rate of gold at that time. Imagine at the end of 8 years, the rate of gold is say 6,000 or 6,500 per gram. So you will be given 6,500 into 10 grams, so 65,000 rupees plus this interest of 2.5%. So you will be getting that. So the term is for 8 years, and but there is an exit option will be after 5 years onwards, and the sovereign gold bond will be sold through banks, stock holding corporations, designated post offices, recognized stock exchanges. So it will be available through bank, stock holding corporation, stock exchange, everywhere it is available. And the benefit is quantity, the quantity for which you are paid is protected, and the risk and the cost of storing. The biggest advantage is if you buy physical gold, you have to store it somewhere, and you have to have a locker for that. So the cost of storing will be very high. Instead, you are getting 2.5% interest for the money which you are invested. So if you are not holding physical gold, if you are only that bond, you may not be purchasing any gold, but you are getting as an investment, you are getting it back at any given time, and investors are given the market value of the gold at the time of maturity. Like physical gold, this can no charges, no making charges, so that you are not losing any money for the making charges, and a guaranteed rate of interest of 2.5% is there. And after completion of the 5-year period, you can trade this sovereign gold bonds in the National Stock Exchange also, or the Bombay Stock Exchange also, you can trade it. And banks accept sovereign gold bonds as security against security loans, secured loan. If you want to have secured loan, banks will accept this also. So a lot of advantages are the banks will accept as a security for the secured loans. And the sovereign gold bond, why the government is introduced in? Why the government introduced this? See, India's one of the biggest foreign exchange requirement for India is purchase of gold from outside. India is one of the biggest purchaser of gold. So billions of dollars, billions of foreign exchange reserve is used only for purchasing gold from outside. So the government felt that we are losing precious foreign exchange reserve for purchase of the gold. See, we are purchasing crude oil, but it has to use for the day-to-day working and the running of the vehicles and all. But gold is just purchased and kept. It is not multiplying. So the government felt that we can save some foreign exchange reserve through these bonds. So that, and a person who wants to buy gold, and if he is smart, he can understand that this is the best way to purchase gold. No need to hold anything physically. Your money is safe. And if the gold prices increases, you will get that money back also. Definitely, you will get the money back, and there is no cost of saving, or there is no cost of protecting and keeping it. And you get 2.5% interest also. And if the gold price increases, you will get that advantage. So this gold scheme is a win-win situation for government as well as, and government is getting a long-term investment, a bond. They got the money, they can use it for long term. 8-year bond is there, and the interest rate is only 2.5%. Of course, yes, the government will have to pay according to the increase in the gold price. But this year, 2020, please don't forget, the gold price have gone almost 37% increase. Okay, 2020, the gold price increased by almost 37%. So that is huge growth. But of course, we do not know whether it will continue like that. It may come down also, because during the corona time, because of the confusion, because of the fear, because of the uncertainties in the market, in the stock market and everywhere, the people are finding gold as a safe mechanism to invest. That is why the gold prices are going up. But how far it will come down and all, time only will tell. But if you go by, if you are an investor in the gold this year, you would have got 37% growth. It is huge. And normally 3 or 4 or 5% growth, not more than that. But you are talking about 37% growth this year. Anyway, so this gold bond scheme was introduced by Government of India in November 2015, and it is as good as a government bond, sovereign bond. So safety is 100% guaranteed, plus you are getting some 2.5% interest also. It is a win-win situation for the investor as well as the government. So that is so the latest round is going on right now. The latest round of sovereign gold bond scheme is going on, and people can invest. You can purchase even from post office this gold bond, or from the designated banks, or from the stock exchange. So there is a lot of option to purchase this sovereign gold bond. Okay, so that's about it. Now another topic, that's about the Bharat Bond ETF. So the latest round is still right now going on. That is why I am talking about this. You might be knowing about this Bharat Bond Exchange Traded Fund. Okay, ETF means exchange traded fund. So the latest round of the second round of Bharat Bond was initially offered in December 2019. Bharat Bond, the initial series of Bharat Bond ETF came in December 2019, and it is oversubscribed also. Around 12,000 crore rupees were collected with that. 12,000 crore collected. Now, a second round of this is going on in August, in July. Sorry, in July 2020, the second round of Bharat Bond ETF, and the second round, the initial round of this is like it's a bond market, and it is managed by ICICI, and this round is managed by Edelweiss fund. It's a Edelweiss mutual fund. Edelweiss mutual fund is managing this, the second round of the second tranche of the Bharat Bond ETF. So Bharat Bond ETF is an exchange traded fund which will have a defined maturity tenure. So it's a bond, but it's a bond for public sector companies. Bharat Bond is a exchange traded fund in an exchange in the stock exchange. It is traded. It has a defined maturity tenure, and will invest in AAA rated companies. It will be invested in AAA rated bonds of public sector companies, and this new fund offer of this, the second round is in July, I already said, and it will offer two maturities. In fact, a 5-year-old maturity and 11-year maturity. So there are two bonds, one a 5-year maturity and another is 11-year maturity. 11-year maturity to cater the needs of both short-term and long-term investors. And according to the report, this 5-year maturity, which will be matured in April 2025, it will get an yield of around 5.6%. Whereas the 11-year maturity, it will get in April 2031, and it will get an yield of around 6.75%. Okay. So that is the yield expected, and this Bharat Bond ETF, and in this April 2025, the short term, it will be investing in public sector units like REC, the Rural Electrification Corporation, Power Grid Corporation of India, National Housing Bank, IOC, Indian Oil Corporation, then NABARD, Hindustan Petroleum Corporation, NHPC, then Indian Railway Finance Corporation, NTPC, Nuclear Power Corporation, etc. These are the companies in which it will be invested, and this Bharat Bond ETF, it will get, that it will be treated as a debt fund, and you will get the tax benefit, and the taxation will be only 20% on your returns. Okay, please remember, the tax payable is only 20%, of the returns, not more than that. And also this Bharat Bond ETF will be it is the first corporate bond ETF issued in the country. It is the first corporate bond exchange traded fund, ETF. That means this bond is traded in the exchange, in the stock exchange. That is the meaning of exchange traded fund. Okay. So you buy bond and you can sell it in the market tomorrow. So there is no problem with it. There will be in the secondary market. You purchase it right now when it is issued, then you can sell it in the market, and it may be it can be sold in a premium. It may be sold at a loss also. It can be there, but it's like any other stock which you have. You can sell it in the market also. And the government has come up with a Bharat 22 ETF at that time for the individual investors in December, so that we can say it is a part of the government disinvestment program. You can say it is part of the government disinvestment program, and this is an open-ended ETF. That means you can sell in the market. The funds allow the investor to invest in a basket of government owned and private sector entities. I mean, whichever companies are involved in that. Suppose 20 companies are there. So you are investing in a basket, not this one company, in a basket of companies, so that you are more assured of the return. Basically, even if one company fails, the other companies are there, they will pay you back. So that is why the basket of company advantage. So this Bharat Bond ETF, it will be used for a basket of companies mentioned in that list. And the biggest advantage is, it's tradable on in the exchange market, and also small unit size. Per bond is only 1,000 rupees. You can buy the unit size is as small as 1,000 rupees. A transparent net asset value every day. In intraday also you can sell it, and a lot of transparency as far as the disclosures are concerned. So that is why this Bharat Bond is considered to be a very transparent and low cost as far as the management fee is concerned, and you are investing in AAA rated companies, the public sector companies. So the safety of the assurity of you getting back the money is equally there, and the interest rate, I said 5-year interest, 5-year term is also there, and 11-year term is also there, depending upon those who want to invest in long term and those who want security. These bonds will help, because it is almost like a sovereign bond. It is not exactly, but it is for public sector companies, especially for public sector companies, and that too those public sector companies which are rated very high. Their the financial stability is very high. AAA rated means these companies have extremely good financial conditions. Financial stability is there. So if such companies are issuing bond, so what are the advantages for the companies? For the companies, they are getting loan. When they want issue, it's like a loan, and this is at a cheaper rate, a lower rate, and it is for long term they are getting. So at the end of 11 years, they have to pay 6.75% interest only. So that is a very reasonable and very decent return, and the interest rate. So the companies can invest this in long term, in the capital investment can be done, and even if the returns are not there immediately for the company, if it is a big capital investment for the company, and after 11 years they have to pay back, and that to just 6.75% interest rate. But as an investor, a purchaser of the bond, what is the advantage? We are investing in a safe place, safety, guaranteed return, even if the interest rate is slightly less. So that is the concept of Bharat Bond ETF, and as a purchaser, I can trade this. Suppose today I purchased it, tomorrow I can sell it in the market. I need not worry if I need money, if I need some liquidity immediately. Say I invested 1 lakh rupee in the Bharat bond. So, first of all 1 lakh rupee is safe. Now, you have a chance of selling it in the market also, and there will be many after some time, and considering the yield, many people will be purchasing at a premium, or rather because the safety involved, many people may be willing to purchase at a premium also. So, you can trade it in the exchange, I mean in the stock exchange also. So, that is the advantage of this kind of a bond. So, Bharat Bond ETF, the second tranche is managed by Edelweiss. Earlier it was managed by ICICI Pru. So, now it is in the hands of Edelweiss Mutual Fund, and the second tranche came up in July 2020. The first tranche was in December 2019, and it is oversubscribed at that time. 1.7 times subscription was there. Almost 12,000 crore rupees were collected through the Bharat Bond ETF. Let us move into another topic, and there is a term called fully accessible route. Fully accessible route, FAR. You might have heard this. This was mentioned in the budget speech also. The Reserve Bank of India has introduced a separate channel, namely fully accessible route to enable non-residents to invest in specified government bonds, to invest in specified government bonds. Okay, to enable non-residents to invest in specified government bonds with effect from 1st April 2020, this fully accessible route. So, this move it was already announced in the budget. Okay, this was announced in the union budget. This was announced in the union budget, and under this fully accessible route FAR, eligible investors can invest in specified or specific government securities without being subject to any investment ceiling, and these customers can invest without any investment ceiling. There is no investment ceiling, and there are also two other such schemes. One is this, I already said that this is the fully accessible route. There are two more similar schemes, FAR, fully accessible route. Then there one is another is MTF, medium term framework. Medium term framework, and the third is called voluntary retention route, VRR. Voluntary retention route. Voluntary retention route. So, this will substantially ease the access of non-residents to India government security market. See, basically, the government security market, and facilitate inclusion in global bond indices and all. So, basically, we want the non-resident Indians to invest in Indian security market, the India government security market. We need more and more people to buy government securities. Whenever a security is issued, basically when we issue government security means what? Government is issuing a bond, sovereign bonds. and people should buy so that government can get this money and spend for the day-to-day requirements or large-scale investment, whatever be the reason for which we issue the bond. So, this voluntary retention route, the RBI, this is a separate scheme to encourage foreign. So, when we went to the voluntary retention route, let me talk about that also a bit. So, FAR I said. Now, as far as the VRR is concerned, this is again announced by RBI to encourage foreign portfolio investors to undertake long-term investment in Indian debt market, to undertake long-term investment in Indian debt market. To undertake long-term investments in Indian debt market. And under the scheme, this VRR, the foreign portfolio investors have been given greater operational flexibility in terms of instrument of choices and in which bond they have to invest, and also exemption from certain regulatory requirements. So, that is the idea behind this VRR. So, basically in all these three cases, whether it is FAR, okay, this is as I said fully accessible route, or MTF, medium term framework, or VRR, our aim is to provide better facilities for non-resident investors in government bonds, so that India can easily get. So, this government securities or government bonds. So, government securities are also, now what do you mean by this government security? You know it very well. When the government, sovereign bond, when the government is issuing a bond, that is what sovereign bond, or a government security. What do you mean by the government security? Government security, or it is also known as GSEC. Government security is also GSEC. It is a tradable instrument issued by the central government or the state government, a tradable instrument issued by the central government or the state governments, and it acknowledges the government's debt obligation. That means it's a debt. Government is taking some loan, some debt. It will acknowledge, that instrument will acknowledge the debt obligation, and there it can be a short term as well as long term. Now, this debt obligation by the government can be short term or it can be long term. Please don't forget, you know it, but I am just repeating. If it is a short term one, we normally call it as a treasury bill. If it is a short term one, it is called a treasury bill. So, with original maturity less than 1 year, if it is less than 1 year, it is called a treasury bill. Normally, treasury bills of 91 days, it can be 182 days, 3 months, 6 months and 364 days. So, then we call it as a treasury bill. Okay. Short term debt taken by the debt obligation of the government, we call it a treasury bill. It can be of 91 days, 182 days or 364 days. Then long term debt, long term one, we call it as government bonds or dated securities. Long term, we may call it as the long term one, we call it as government bonds, or dated securities. Date will be mentioned. I said in the Bharat Bond, April 2025 or April 2031, dated, a particular date also will be there. So, the original maturity of the government bond or dated securities, we call it as, if it is more than 1 year term, it is called long term government bonds or dated securities. So, in India, in Indian scenario, the central government can issue both short term as well as long term, treasury bill as well as dated securities. Central government can issue treasury bills as well as dated securities. Whereas state governments will issue only dated securities. State government issue only what you call state development loan and normally only dated securities or state development loans. And this government securities carry practically no risk because government is taking the loan. So, normally zero risk, especially if a stable government like India's, a stable system, no problem, it is a risk free, and that is why these G-Secs are also known as gilt edged instruments. These G-Secs or government securities are also known as gilt edged securities or instruments. Gilt edged instruments. So, gilt edged instruments are high grade investment bonds offered by governments and large corporations as a means of borrowing funds. Now, gilt edge can be there from large corporations also, very big multinational corporations if they are issuing bond. So, they also will be gilt edge security only. So, gilt edge securities are high grade investment bonds offered by governments and large corporations as a means of borrowing fund. Okay. So, here what are we talking about? So, our discussion now in this particular topic, our discussion is about the government taking loan from fully accessible route whereby we are looking at non-residents to invest in specified government bonds. And RBI is talking about three types of such route. One is fully accessible route, which is mentioned in the the recent budget itself. Then we have medium term framework MTF and voluntary retention route. So, three different routes, these different schemes for attracting non-resident non-residents to come and invest in Indian security market, especially the government bond market, or we can say or gilt edged the GSEC government securities. So, we are talking about the government securities, and there can be government securities can be of two types: the tradable instrument issued by the central government, state government, treasury bills, and the dated securities. So, we are talking about that. Okay. So, the G-Secs are gilt edged securities because of the it's a high grade investment bond offered by the government, 100% guarantee of return. That is why it is called gilt edged securities. So, that is about the this particular topic. Now, coming to another one called operation twist, some twist in the operation. Okay. Let me talk about operation twist. The Reserve Bank of India has announced to conduct, and in fact they have conducted operation twist in the under its open market operations, under its open market operations in December 2019, operation twist. So, it is a name given by the US Federal Reserve monetary policy operation. Originally this name has come from the US Federal Reserve monetary policy operation. Monetary policy operation, which involved in the purchase and sale of government securities to boost the economy by bringing down long term interest rates. See, in the operation twist, they tried to reduce, to bring down the long term interest rate, to bring down long term interest rate. Okay. Now, under this operation, now what is that in RBI is doing? RBI will simultaneously buy, or RBI simultaneously purchased and sold government securities worth 10,000 crore each. Okay. So, what the RBI has done on December 23rd, 2019, RBI sold the securities worth 10,000 crores, and then RBI purchased another 10,000. So, it sold, then also it purchased 10,000 crore worth securities. On the same day, they sold, got some money, and using that money you purchased another set of. So, the advantage was that when the RBI purchased it, it is a 10-year bond where the the maturity is in 2029. The government security 2029 for an interest rate of 6.45%. So, a 10-year bond, a long-term bond they have issued, and the bond was issued, and it is for 10,000 crore rupees. 10,000 crore rupee bonds were issued with 6.45% interest rate. At the same time, on the selling side, the RBI already sold the which was securities of 10,000 crore, which were getting matured. The GS 2020 at 6.65%. Also, GS 2020 at 7.8%. Some of them were short term maturities. GS government security 2020 at 7.8%. Also 8.27%. GS 2020 at 8.27%, and also 8.12%. Another government security 2020 is getting matured in 2020 of 8.12%. So, these securities were getting matured in 2020, but they were government was paying a higher interest rate. Now, we are offering just 6.45%. So, in the end, the same loan, or other government continued with the loan, but at a much lower interest rate. So, you are saving lot of money as far as the yield is concerned, as far as the interest is paid. That is why operation twist, you you sell off, or rather you what you call, you pay off some of those high interest rate bonds and issue new bonds at a lower interest rate, so that the overall cost of the interest will be very less. The yield which you have to pay will be very less. So, from 8.4 to 8.27, 8.12, 7.8% and all, it has been reduced to 6.45%. So, all these 4 securities which are short term, which were maturing in 2020, the government has got rid of those securities, and then they issued fresh securities at a lower interest rate. So, this has helped in managing the yield, managing the interest rate. Okay. In US, the US Federal Reserve also did the same thing, operation twist, in 2011-12. For US point of view, in US they did this in operation twist in 2011-12. By making long term borrowing, or rather their aim was also to convert the long term borrowing more cheaper. Now, this is part of an, I already mentioned when I was saying operation twist, it is the Reserve Bank of India announced operation twist under its open market operations. Now, what do you mean by open market operation? Okay, open market operation. So, this operation twist by RBI is part of the open market operations. Now, what do you mean by this open market operation? That is the question. The open market operation is one of the quantitative, the quantitative monetary policy tool. It is a quantitative monetary policy tool which is employed by the central bank of a country to control the money supply in the economy. The main aim is to control the money supply in the economy. So, they are trying to control the money supply. So, when they issue these bonds or rather the securities, what will happen? People will purchase and the money will come to the to the RBI, to the government. So, the money supply in the market, in the economy will be reduced. Okay. So, open market operations are conducted by RBI by way of sale or purchase of government securities, which we call the G-Secs, to adjust the money supply condition. So, if you sell, it will mop up the money, it will collect the money from the market and the money supply in the market will be reduced. Or so the same way these operations are conducted on a day-to-day basis depending upon the requirement, whether it is to pump in money or to mop up the money. And RBI carries out this open market through commercial bank. Please note, RBI is not directly doing any open market operation, it is done through commercial banks and does not directly deal with the public. RBI does not directly deal with the public. It is through banks. So, these securities are issued, whether it is selling or purchasing of the securities, it is done through the commercial banks. It is not directly by the RBI. Please remember this. So, this open market operation is one of the quantitative monetary policy tool. Okay. So, the quantitative to regulate the control of the total volume of money. The idea is to regulate and control the total volume of money in the market. So, it is a we can say quantitative monetary policy tool which is employed by the central bank, by the RBI, to control the money supply in the economy. This is, so that is why it is called open market operation, to control the money supply in the economy, right. So, that is about the open market operation, and also I was talking about the operation twist, which was done by RBI in December 2019. Now, coming to another topic, the 7th economic census. You might have heard about this. Okay, the 7th economic census. See, the Government of India recently announced the extension of the data collection period of the 7th economic census by 6 months. 6 months extension. I think they will have to extend further now till December 30th, sorry, till 30th September 2020 because of the coronavirus pandemic. The government announced the extension of the data collection period for for the 7th economic census by 6 months. Now, it may be extended further because this cannot be conducted, and this is made by the Ministry of Statistics and Program Implementation. So, this economic census is done by Ministry of Statistics and Statistics and Program Implementation. See, this survey, this economic survey engages almost 1 million people in field work. I mean, it's chota mota nahi, it's not a small one. It engages almost 1 million people in field work. 1 million people in field work, and the data is collected through the door-to-door survey of each household and commercial establishment. Door-to-door survey of each household and commercial establishment. It is done under the provision of Collection of Statistics Act 2008. It is done under the law called Collection of Statistics Act, Collection of Statistics Act 2008, and the 7th Economic Census it is conducted through in a Common Service Center, CSCs. It is conducted through Common Service Centers. And it is the first time the census is being conducted digitally. So, that is another first. And this economic census is counting. What is that? What do you mean by the Indian economic census is the counting of the entrepreneurial units in the country. It is the counting of the entrepreneurial units. Entrepreneurial units in India, and it involves both agriculture and non-agricultural activities. It provides what are the information it want to collect. It provides information such as number of persons employed, number of establishments, type of ownership, source of finance, etc. Everything will be collected. So, the number of persons employed, number of establishments, type of ownership, source of finance, etc. The information provided by the census is used for planning, assessment of the contribution of various sectors towards the GDP of the country. And the Indian economic census, the first census was launched in 1977. Please do not forget, it is the 7th one we are talking right now. The first one, economic census, was in 1977, and then 6 census are already held. 77 it was held once, then 1980, then 1990, 1998, then 2005 and 2013. 2005 and 2013 were conducted, but now we were in the process of almost on the verge of publishing it in 2020, but it has been postponed now. Okay. So, the economic census, 7th economic census is extended by another 6 months right now, and we may have to extend further because of the coronavirus pandemic. You know very well, things are in bad shape for the country. So, this census may have to be, the time period may have to be extended in future also. Okay. So, that is the situation of the 7th economic census. Then there is another topic called Automotive Mission Plan. Automotive Mission Plan 2016 to 26. Automotive Mission Plan or AMP, Automotive Mission Plan 2016 to 26. It envisages creation of 65 million jobs, 65 million jobs in the automotive sector. The Minister of the Heavy Industries and Public Enterprise, it talked about, and this plan was further explained in the Rajya Sabha recently. The Automotive Mission Plan is the collective vision of Government of India and Indian automotive industry. It is a collective vision of Government of India and Indian automotive industry. It is a collective vision, and to lay down a roadmap for the development of the industry, and it came up with a vision. Please note, this automotive industry and Government of India in the AMP, they have came up with a vision 3, 12 and 65, meaning the Indian automotive industry aims to be among the top 3 of the world engineering, manufacture and export. Top 3 of the world's engineering, manufacture and export of vehicles and auto components, and export of vehicles and auto components. And also we want to grow in value to over 12% of India's GDP. Automotive industry should reach around 12% of India's GDP. 12% of India's GDP and should generate an additional 65 million jobs. 65 million jobs. So, there was an automotive mission plan 2006 to 2016. In that, the aim of around 25 million jobs we have already achieved. AMP 2006 to 2016 was there. The target was 25 million jobs, and it is almost achieved. By and large, achieved that. So, now we are talking about 16 to 26, so that we can make or we can expand this industry to 65 million jobs. So, top 3 in the world, it should become 12% or it will achieve around 12% of the GDP of the country, automotive industry and the component industry or the spare part industry, and it should provide 65 million additional jobs. It is a huge task. That is what it has been envisaged. It will definitely help in the Make in India concept or the Skill India program. All these things will get a big boost if we are able to do through this automotive industry, and the next exports of the Indian automotive industry should be increased many-fold in the process. So, that is what is called this AMP, okay, the automotive automotive mission plan, 2016 to 26. It has been recently unveiled in the Rajya Sabha by the minister by our Nitin Gadkari, and he was talking about, okay, he is a minister of heavy industries and public enterprise, okay. So, that is what we are planning in the automotive mission plan. Now, coming to another topic, this is called, recently India banned FDI from neighbors, banning of FDI from neighboring countries. Not a big topic, just to know. In April 2020, India decided to ban foreign direct investment through automatic route from neighboring countries that share a land border with India. Okay. So, the automatic route for FDI without any special permission, automatic route for FDI through automatic route for FDI from neighboring countries that share a land border with India, that share a land border with India. So, we are putting a restriction on those countries that are sharing a land border with India, and it is FDI, this was banned because the reason is Chinese investors may exploit cheap valuation in the depressed economic conditions, especially after the lockdown. See, during the lockdown, the stock prices actually came down, and we had a fear that China has surplus foreign exchange reserve also. They have plenty of sovereign fund also. So, the fear was that the Chinese investors may exploit the cheap valuation in India. The Chinese investors may exploit the cheap valuation in India, especially after the collapse or rather the sudden decline in the stock market. And so, the Chinese companies may pick up equity interest in selected companies. Even countries like Italy, Spain, France, Australia, all of them have taken similar action to protect their business from Chinese investors, because China has surplus foreign exchange reserve, 3.2 trillion dollars are there with them, 3,200 billion dollars are there with them. So, they can use it in value picking. They can identify the good companies where right now the valuation is very low. So, that is why we have started. So, these investors are fishing for distressed entities in need of cash in the post COVID-19 scenario, and because of that we wanted to prevent Chinese from misusing this opportunity. China's investment in India has been increasing over the last 5 years. According to some estimates, the total and the current planned investment by Chinese entities in India is more than $26 billion. According to some estimate, China has already invested or about to invest around $26 billion in India. The Chinese capital is invested in many a times in the brick and mortar industries, technology industries, startups. In most of the startups, Chinese investment is there. So, the idea is to control the Chinese investment, and China should not take undue advantage of the distressed market situation because of our all India lockdown and the economic downturn through which we are going through. So, that is the idea behind. So, now instead of saying that we are banning Chinese, the new order says we are banning foreign direct investment through automatic route from neighboring countries that share a land border with it. So, it is not China specific, it is we are talking about Nepal, Bhutan and all as if, but our aim is only China, but we have said that we are banning the automatic route from neighboring countries that share a land border with India. So, that is the situation, but this kind of blanket ban, how much it will help and all, we do not know. Okay. So, let us see. Now, another topic, a small topic, RBI launches this Obicus. Just if you know the name also, it will be sufficient. So, Reserve Bank of India launched the 49th round of Obicus of manufacturing sector, 49th round of Obicus for the manufacturing sector. For the manufacturing sector for the period of January to March. (2020), and in fact, this is the capacity utilization survey. Okay, so in the latest survey, what happened to the manufacturing sector? So, what do you mean by Obicus? Obicus is the order book, inventories, and capacity utilization survey. Order book, inventories, and capacity utilization survey. Okay, that is called Obicus. And according to this survey, it was found that India's capacity utilization has declined to 68.6% in the third quarter of 1920 from 60. That means the capacity utilization is only 68%. 68.6% in the third quarter of 2019-20. See, that means rather than talking about 100% capacity utilization, we are saying Indian companies, manufacturing companies are working at just 68% of the capacity. So, that is not a healthy thing to talk about. So, this Obicus is order book, inventories and capacity utilization survey. It provides an insight into the demand of the Indian manufacturing sector. It conducts quarterly, 4 times in a year. The first survey was conducted in 2008. First survey of Obicus in 2008. Okay. So, the information collected will include the quantitative data on new orders received during the reference period, backlog of orders, pending orders, total inventories, everything will give us a better picture about the Indian economy. Then another survey I would like to talk is a consumer expenditure survey, another topic called consumer expenditure survey. See, I am specifically looking at what can be asked in the exam for the preliminary point of view, that is why I am able to move very fast. So, the government recently scrapped the National Sample Survey or NSO's Consumer Expenditure Survey, claiming that the data quality is not correct. Okay. So, Consumer Expenditure Survey by NSO, this government scrapped it or rejected it, scrapped this consumer expenditure survey. This All India Household Consumer Expenditure Survey CES is traditionally a 5-year, or it's called quinquennial meaning once in 5 years, recurring every 5-year survey conducted by National Sample Survey Office. Quinquennial is once in 5 years, conducted by National Sample Survey Office, NSSO, and it is designed to collect information on the consumption spending pattern. This National Consumer Expenditure Survey. So, naturally this design of this is to collect information on consumption spending pattern, consumption spending patterns of household across the country, both urban and rural. Consumption spending pattern of households across the country, and the data gathered in this exercise reveal the average expenditure on goods and services and helps generate estimate of household monthly per capita consumer expenditure also. Monthly per capita consumer expenditure, monthly per capita consumer expenditure. Monthly per capita consumer expenditure. So, this data gathered in this exercise reveals the average expenditure on goods and services and helps generate estimates of household monthly per capita consumer expenditure. Also, the distribution of households and persons over the this monthly per capita expenditure classes and all. So, this data released by the survey are also used in determining the macroeconomic indicators. It is, if you are not able to spend, it is an indicator of the stress in the economy. So, macroeconomic indicators and for rebasing the GDP and all. Currently, the base year of survey is 2011-12. The base year of this consumer expenditure survey is 2011-12. And the government has decided not to release the data or which was conducted in 2017-18. So, now what is in news? The government decided not to release the data to All India Household Consumer Expenditure Survey, which is conducted in 2017-18, and the government is claiming that it is because of data quality issues. There are data quality issues. Government is not happy with the data quality. But critics argue even the leaked information, the government, we are talking about a new survey will be conducted in 2021-22 and all. But according to the leaked version of the 17-18 survey, the country has witnessed for the first time a drop in the monthly per capita consumer expenditure, a drop in monthly per capita consumer expenditure since 72-73. So, since 1972-73, for the first time the country has witnessed, according to this leaked, according to the leaked information or a leaked version of the 17-18 survey, the country has witnessed the first ever drop in monthly per capita consumer expenditure since 72-73. So, critics say that the government is, they are true to the style of the government. The government said that, so since this data is not suiting the requirement of the government said that don't publish, there is a problem in the quality of there are data quality issues. It is quite unfortunate. See, we need transparency in all these things. This National Sample Survey Organization, if it is doing this work for many decades, you cannot be complaining and saying that now the data is a problem. So suddenly in 2018-19, you are questioning the abilities of the National Sample Survey Organization and the statistical departments. It's quite sad. So this consumer expenditure survey is normally held in once in 5 years and conducted by the National Sample Survey Organization, comes under the National Sample Statistical Office, Ministry of Statistics and Program Implementation in the Ministry Sample Survey Organization, and it collects information on consumption spending pattern of households across the country, rural and urban, and it reveals average expenditure on goods like food and non-food items, services, monthly per capita consumer expenditure, and also the distribution of households and persons over the monthly per capita consumer expenditure in classes. So, all these things are released, but unfortunately the 17-18 data, normally it is conducted once in 5 years. 17-18 data has not been published by the government, saying that there are issues in the data quality issues, but the reality is for the first time this survey has found that there is a reduction, or there is a reduction in consumption, or there is a country has witnessed the first drop in monthly per capita consumer expenditure since 72-73, and now, so this is the problem. The government is so happy to dish out data only what it suits, the way it is convenient for the government. But a vibrant democracy, a vibrant economy requires all sorts of data. Even if it is not a happy data for the government should not be stopping that data from getting published. You publish and say that yes, there is a problem, we are identifying it, we would like to work and improve on it, rather than saying that don't publish this data because it is not suiting my requirement or it is not suiting my narrative. This is something quite unfortunate. So, anyway, so that is about this National Consumer Expenditure Survey, and that is all about my economics for the day. And after half an hour gap at 3:30 or 3:35 rather, Manish will continue his topics. So, this for this week. Next week I will be talking about geography related, I will be talking about international bilateral, science related. So, all these topics will be coming. So, that is all about. So, I have covered 25 topics related to economics. Please look into that. I feel some of these topics can be definitely asked in the exam. Very important, easy to understand, there is no problem. I might not attach the very hardcore things in such a way to make sure that even you have a comparatively lesser idea about economics, you should be able to get these topics very easily. That is why I have covered. So, economics and related topics, okay, you can say that. So, please study, please utilize, please revise and gear up. Now, the number of days are just 40-45 days, less than 45 days. Make sure that you are doing it seriously. Revision is the key, practicing questions are the key. CSAT, paper 2, practice is a must. Please don't give up. You can still make it for more than 40 days time, good enough to get through the exam. You can easily manage if you have the will and determination to work hard and sleep less, study more, 12 hours, 13 hours, 14 hours per day. Now, next 40 days, 45 to 43, 44 days can be very crucial for you. If you don't give up, 100% you can clear this preliminary, and it's a wonderful opportunity for you. Don't give up. See you next week. Meantime, please participate in the test. The science test is there, and various module tests we have conducted. Those who did not take the test, you please take the test. It's still available on your in a portal. Please use this opportunity. Take the test. Thank you. Bye bye. And at 3:35, Manish will continue with this topic.